Hello, welcome to the Asset Allocator podcast. I'm Amina Zafar, Funds Reporter at AA. Joining me today is Dan Capps, Lead Portfolio Manager of Index MPS at Evelyn Partners. Hello, Dan.
Hi.
Also in the studio is our very own contributing editor, David Thorpe. Hello, David.
Hello.
In this week's episode, we'll explore how index investing has evolved from its origins as purely passive into something far more nuanced. We'll also look at where firms can add value or generate alpha. So what does this mean for how portfolios are constructed today? Well, let's delve into it. So Dan, as you know, index investing has evolved, but how has it changed in recent years and how accurate is it to still class it as purely passive?
Well, index investing has evolved hugely over the last few years, and particularly over the last 20 years. And the reason why I mention that time frame is I first started working in index tracking strategies in 2006. And I recently looked using Morningstar Direct at the number of index tracking strategies you had available in UK and Europe as an investor, as a portfolio builder, back in 2006. And there was 145 index tracking funds and ETFs available. So in terms of your options on portfolio construction, you had very limited range of options out there. This was largely market cap weighted indices, broad one benchmarks, and of those 145 instruments, you were going to see a lot of duplication, tracking similar or the same index. Fast forward 20 years, there's now nearly 5,000 index tracking funds and ETFs available for sale out there. So that means, again, as a portfolio constructor, you have a much wider range of options available to you in terms of styles, allocations across regions, sectors, factors. And that means that we can now build portfolios which precisely reflect our in-house asset allocation view, but use low-cost, well-diversified index tracking funds. So that evolution that we've seen from these quite humble beginnings of not too many instruments available to, as I say, nearly 5,000 now. We can be much more precise about how we implement portfolios, not just in equities, in fixed interest, in alternatives. And so that means you can have an active asset allocation framework, a quite clear picture of your view of the world, and implement that using low-cost, well-diversified funds.
And over that period of time, as you say, lots of new product has come onto market, but also new terminology has come into being, evidence-based investing or evidence-based strategies. Funds are no longer passive or tracker. They're now often called index funds as well. Smart beta is a term that's used. What do those terms mean to you, and how do they differ from each other? And do you have all of those terms, if you like, or strategies represented in the products that you run at Evelyn Partners?
So at Evelyn Partners, we prefer the term index investing. We're quite deliberate with that. One of the reasons for that is, of those terms you mentioned, passive investing. Passive outside of the investment world is quite a sort of derisory term. And so the IA have done a study where they looked at retail clients and investors and asked them what they understand from passive investing. Their comprehension of what it was, the strategy was not particularly good, but also their initial reaction to that was one of, it doesn't sound like you're doing an awful lot. So in terms of articulating your value in that relationship, if you're saying, we're going to implement a passive portfolio, you might believe that a buy and hold strategy with limited intervention is right for your clients. But immediately when you say passive, you're almost starting that conversation on the back foot. So that's why we prefer terms like index tracking, emphasizing low cost, diversification. But we refrain from using passive as that initial way of describing what we're doing, because within clients, the understanding might not be there. And then you have to sort of have that winning of hearts and minds from that. The other phrase that you mentioned is evidence-based investing. I think this is a really interesting one for me, because a lot of what I would say is the philosophy of evidence-based investing we do implement in index MPS, but we don't use the term evidence-based investing. For me, evidence-based suggests that there's a body of evidence that you follow, and then from there that leads you logically through steps into your portfolio implementation. And my understanding of that would be you'd look at the body of evidence, and then all of the portfolios, or many of them, should look really quite similar. I've seen quite a lot of evidence-based portfolios that look dramatically different from one another, and I think there's actually very good reasons for that. Depending on what bit of the evidence that is largely used to support these types of strategies, one is, on average, active managers underperform their benchmarks. So there's been studies that might have shown this, and so that leads you towards index investing, market cap weighted strategies. Buying that benchmark, and by definition, market cap weighted strategies skew towards mega cap, large cap. They're market cap weighted, but they also skew towards growth, as the companies that share price performance have performed best form bigger parts of the index. So they have a large cap or a mega cap growth bias. Now, within the evidence-based investing sort of body of evidence, people are also following the farmer French strategies. They might be following, the factors of value and smaller companies. And this is the antithesis of market cap weighted. If market cap is mega cap and growth, farmer and French factors of value and small are the other side of the style box to that. And so then your decision is, well, how much do I have in market cap? How much do I have in factors? Other things like, what is my home bias? What is my rebalancing schedule? And you can use the same body of evidence to get to very different portfolio implementation. And so I feel like this, it's evidence-based, we're just doing that, and that leads nicely into this portfolio that we've implemented, is an oversimplification. So in index MPS, we do start with market cap weighted indices. We do like to offset those biases by bringing in exposure to value and smaller companies, but we don't call it evidence-based, because there's also an inference there that you're following the evidence and other people aren't, and I'm not sure that's particularly fair. But for us, index tracking is the right way to describe what we're doing, especially given we've got sort of active asset allocation overlays within our portfolios. But we just like the low-cost, well-diversified nature of those building blocks.
Coming up later on Asset Allocator, we'll explore rebalancing and the rise in blending index solutions with active offerings. Join us after this quick message.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Welcome back to Asset Allocator. So Dan, as an index investor, where do you feel Evelyn can add value or even generate alpha?
I think the answer to this is quite simply asset allocation. We know asset allocation is the large determinant of client returns. And so, how we're positioned within the portfolios, which indexes we decide to track and what allocations we decide to bring in, that's where we're bringing value to clients. A great example of this is 2022 and entering 2022. So we know in 2020 and 2021, post-COVID, we had supply side constraints, and then we also had demand driven by furlough checks, stimulus, and people not being able to go out and basically having lots of money to spend and nothing to spend it on. So this was driving up inflation, and at the time central banks were talking about a transitory inflationary environment, which they thought that might just resolve itself once COVID itself was resolved. But as we got closer to 2022, it was quite clear that wasn't going to be the case. Central banks would need to act quite quickly in order to combat inflation. And this logically meant that we were going to see quite sharp interest rate rises. So for us, if we were following a decade of very low interest rates, fixed interest as an asset class wasn't particularly attractive. And then if you're holding sort of duration assets, that was something where you weren't really getting paid to hold them, and you were embedding a lot of interest rate sensitivity and risk into your portfolios, into what looked to be a rising rate environment. It was really quite easy for us to be underweight fixed interest at the time. Then when we did start to see rates rise, keep our duration short. So I think 2022 was a pretty horrible year for most investors. Our portfolios did fall, but they didn't fall as much as what I would describe as those more naive passive portfolios that might be a blend of MSCI equity and global ag. Global aggregates, these common 60-40 portfolios, aggregate was about 7 years in terms of duration. The fixed interest element of those portfolios was really quite badly impacted during this time. And by being a bit more nuanced, having that active asset allocation overlay meant we were able to protect investors a lot better during that downturn. Where I felt this, what I guess maybe bothered me most in this environment was the more cautious investors. I mentioned 60-40, but if you think about 40-60 or even more when you got allocated to that broad bond benchmark and how much those portfolios fell in that environment, this isn't necessarily what cautious investors signed up for when you're doing your initial asset allocation and risk profiling. I think it's fine for more risky portfolios to have some volatility and some drawdowns. That's possibly what you have in your client conversations. But the drawdowns we saw on those more cautious portfolios, I think, were probably outside the parameters that people might have originally set in terms of expectations with their clients, and that was something we felt was possibly a bit avoidable, and where these other passive portfolios maybe fell short.
I guess that's one of the challenges is to your point about cautious portfolios. 2022 was a down year for markets in lots of ways and for lots of reasons that you outlined. But it was also a year where actually an aggressive portfolio might have beaten a cautious portfolio despite it being a down year. And given the idiosyncratic nature of the risks that are out there and the threats that are out there to portfolios today, when you're thinking about the asset allocation piece, which is where you aspire to add alpha, what does asset allocation look like for that more cautious client?
So for the more cautious client, I mean, fixed interest has still been, a major part of more cautious client portfolios. And so we look to keep we're still keeping our duration relatively short, but we're looking beyond just your standard broad global ag allocation, which is very heavily government bond dominated in terms of that. So we might want some more exposure to credit, but keeping our credit duration short as well to capture a bit of the upside that comes from those spreads. We've had exposure to US tips and inflation-linked gilts to help add a bit of inflation protection to the portfolio, and then also alternative asset classes come in as well. We've held gold in the portfolios for since 2022 and before, and we know that's been a great allocation to have. It's not something you see too commonly in passive portfolios, so that extra layer of diversification does add something else for us as well.
So Dan, I just want to understand your views on rebalancing. Is it as simple as just doing it every quarter?
I would suggest absolutely not. I think rebalancing is probably underestimated in terms of its complexity in delivering an MPS to the end client and to the IFAs that we partner with. What we have seen is sort of proliferation of MPS because they are really easy to sort of launch and get off the ground, but operationally they are really quite difficult to continually manage and maintain. And rebalancing is where you can see the most sort of pinch points operationally. So with rebalancing, due to different settlement cycles, you're almost certainly going to have a bit of out-of-the-market exposure for your clients during this period. Depending on what platforms and what instruments you're trading, there might be some trading costs as well. So it's not something that we choose to enter lightly. We rebalance when we're making changes to our asset allocation, changing our view, or changing some of the funds within the portfolios we found something better or something else that we want to bring in. So we need a reason to rebalance. What we also do is we have an operations team that take care of that. So, we've been doing MPS for more than a decade, and we have a dedicated operations team that work very closely with the investment management team, but are a standalone function, and they deal with all of the platforms, all of the onboarding for the holdings that we want, and crucially deal with these rebalancing exercises. So it's not something that we undertake lightly, but it's something that needs to be very carefully managed when you do it.
So on average, how often would you say you do it?
I don't think that necessarily a quarterly rebalancing cadence is a bad sort of if you've got changes to make, but we've certainly had periods of say 6 months or more where we haven't rebalanced the portfolios, but it's just that we're going to do it every 3 months, come rain or shine. We don't think necessarily delivers the best client outcomes. So quarterly might not be a bad rebalancing cadence to aim for, but we just don't do it automatically every 3 months. So we are looking for when we want to bring changes into the portfolio. Sometimes there's been periods of 6 months where we haven't made any asset allocation changes. We haven't wanted to change any of the underlying funds, and so we're happy to not rebalance the portfolios. But crucially, in between those times, we do monitor the portfolios for drift. And if the portfolios have drifted quite a lot, then we can do what we call an ad hoc rebalance, where we're just bringing it back to target and not making any changes. But that is something that we do rarely. And I'd suggest that over the long term, rebalancing is crucial to maintain the correct risk profile and to maintain things on target. But to rebalance too frequently is often undesirable. And we just caution against doing it for the sake of it.
Have you found in 2026, Dan, that you've been rebalancing a bit more given the extended volatility that we've had?
Honestly, no. With greater volatility, there becomes sometimes a a desire to be seen to be active. But as we saw in the volatility that we had in 2025, if you remember the tariff tantrum and Trump in the Rose Garden with the sandwich board and the tariffs on penguins in the McDonald's Islands and things like that, we that was one of the occasions that, from an asset allocation perspective, we did hold our nerve, and we didn't make too many changes. And then the recovery in there was really quite sharp. So although there can be an urge to be seen to be active, during volatility, things can happen very, very quickly, and it is extremely difficult to get that timing correct. And also, the volatility that we've seen this year, particularly driven by the conflict in Iran, what the impact that had to energy prices, but then the swift recovery we saw, sort of a month after that. I'm not sure how many people could really, see that coming, could market time that. So just because you see volatility, sometimes it's the right time to be making changes, but also sometimes it's the time to just let the markets work themselves out. And sort of we've been probably in the latter camp in more recent years.
So, Dan, how often do your clients blend your index strategies with active solutions? Is that something you see quite a lot, or is it rising?
It's certainly rising. And it's something that we do see more and more of. And I think we've observed two trends in sort of wealth management over the last 5 or 10 years. That is the rise in sort of cost-conscious clients and the rise in people becoming more benchmark aware. And with both of those, that leads you towards index tracking strategies. So it's now much more common to see sort of a core allocation in the US. It might be the S&P as your sort of core allocation, sitting alongside a more high conviction active allocation alongside that. So we are seeing that blend a lot more. And this could also be why we're seeing the rise of these active ETFs that are benchmark aware, sometimes called beta plus, that are offered at a lower price point than a lot of traditional active funds, because they bring you to that more cost conscious, more benchmark aware, but still have alpha opportunities. So if you like blending a low cost index tracker and a high conviction active fund, kind of gets you towards a similar sort of outcome. So we're certainly seeing increased use of index tracking strategies in that space. But then again, as I mentioned, with more factors, sectors, styles available in index tracking, people are looking at this to build out their portfolios beyond just those core allocations. And then in fixed interest, we saw sort of more maturity bucketed fixed interest, so you can be quite precise in terms of your asset allocation. And we've got quite a neat example of this that we've done in-house at Evelyn in recent months, where we had our US tips allocation, and one of the active funds that we had there changed its duration profile quite a lot. And it moved it away from our house view and our house target. So I sat down with our fixed interest team, decided where we wanted to be, and then went away and found an ETF that positioned us there in the US tips curve. And so that allows us to move our allocations towards index tracking solutions that are lower cost and more precisely implement our asset allocation view. So I imagine we might see more of that coming in, using index tracking strategies to reflect the house view, so still being active, but again being low cost and more diversified.
Have you seen a material change in the type of clients that want to access index strategy?
I don't think we've seen a material change in a particular type of client looking to access these strategies. I do think, clients have become more cost conscious. We have had a period where equity benchmarks have performed particularly well. And so there might be across the board a bit more interest in this style of investing, but I don't think it particularly is specific to one type of underlying client. There are market sectors that have moved more towards low cost and index tracking strategies, particularly I think the MPS space. That again is a very competitive landscape, and it is really quite a cost conscious area of the market if you look at where the flows are going. But to me, it kind of comes back to the earlier discussion we were having about passive evidence-based index tracking, the different definitions, and what you or your clients might be paying for when you choose to partner with a DFM who's offering an MPS solution. It's that conversation between price and value. I think, I don't want to say anyone's doing anything particularly badly, but you could, I hope that we can articulate very well where we're adding value along this process with our asset allocation overlay, with our research in terms of choosing best-in-class instruments and things like that. And if we go back to what we're thinking about, the evidence-based investing, I think there certainly is a decision-making process, and along that there's almost certainly some value add in terms of how that's being implemented. What I question is if you have a passive style implementation from your MPS provider, which sits very close to that ACRI and AG that I described earlier, that's something I think that the IFAs can probably quite easily do themselves in-house. Operationally, it might be a little bit more difficult, but what is the right price point for delivering something that is really quite simple? So yes, it might be priced cheaper than other MPSs that are following something similar, but can properly articulate their value add. How much should you be paying for what is essentially at that point something that's just a bit more of an operational outsourcing, not the outsourcing of portfolio construction of much. So I think that's an interesting part of the market and the trend that we're seeing in MPS. But across the board, I think there's just perhaps a bit more interest in managing costs in portfolios.
One of the, I suppose, historic points that one could make about index investing is that it offered diversification. If one allocates to a active US equity fund, for example, the manager might pick 50 stocks out of the S&P 500. So you've got, you own 10 and you don't own 90, and you have to hope that that manager has picked the right 50. Whereas if one buys the index, one gets exposure to all of the 500, and notionally that's more diversified. But actually, the concentration of large cap technology stocks in the index changes that diversification conversation a little bit. One is overweight growth, as you alluded to earlier. One is overweight large cap tech, as you alluded to earlier. But that's not even just a US story now. That's become a global story. Even if one buys a global index tracker, one is in a position where, yes, the US is the largest exposure, tech is the largest exposure, but also Asian tech is a big part of that as well. Has that evolution in the composition of index funds changed how you do your job?
I mean, absolutely, and I think that's fundamentally what we're doing differently within Index MPS to, again, some of the more passive strategies that we see out there. And so part of, I think, being an index manager is to observe how indices are changing. So you can buy the same index, you can buy the S&P 10 years ago, and you might have been sort of close to 20% in the top 10 names in that index, when we know now it's closer to 40%. Tech, media and telecoms and might have represented, again, close to 20%, and now is 40% of the index. So we've observed the index get more concentrated. We've also observed it to get more expensive. And if you're just sitting there buying and holding those same indices, then your portfolio has fundamentally changed underneath you, and you've kind of chosen to do nothing about it. So similarly, we talk about going into 2021, 2022 with the rising interest rate environment that we're seeing. We think this is an observable risk in the market, that there is a potential AI bubble. Now, I think that's quite well, spoken about, and that's not news to anyone. And people would say, well, it might be a bubble, it might not be. But if you look at a index that is that concentrated and almost choose to do nothing about it, then that's where I have the concern. So when we are bringing in diversification in the US, for example, we've got the S&P 500 equal weight, which is obviously buying the same 500 names, but equal weighted. And so that offsets our exposure to those mega cap tech names. And so, by positioning that, we're just bringing in more diversification and more portfolio breadth in terms of the exposures we have. And we think that's just prudent portfolio construction, portfolio management. And I fear that if we do see this bubble burst, and if that does, adversely impact passive portfolios more, you couldn't really say that I wasn't aware of those risks. I didn't see it coming. And they say that history doesn't repeat, but sometimes it rhymes. And if you look back to the .com crash, people think about market cap weighted indices being well diversified, being sufficient protection. But if you bought the MSCI ACWI, the All Countries World Index, in June 2000, admittedly probably the worst time to buy it, you lost money and just about came into profit about 6 or 7 years later as you rolled into the global financial crisis. And 10 years afterwards, on a total return basis, you were still in negative territory from holding a broad global market cap weighted index. That is not what I think passive investors have really got in mind when they're investing in these portfolios today. And again, things like value in smaller companies did give you some diversification at that time, and we're just trying to build something that, as I say, we think is a bit more prudent, a bit better diversified, sort of more of an all-weather portfolio. And we do think there's reasons to be a bit scared or cautious in terms of what we're seeing with standard market cap weighted indices at the moment.
Well, thank you so much for your time, but sadly that's all we have time for today. Thank you to Dan and to David, and thank you to our audience for tuning in. Be sure to join us next week for the Asset Allocator podcast, which you can now watch and listen to across all podcast platforms. You can also log onto our website, ftadvisor.com/asset-allocator. Until the next time, goodbye.